They told you silver is just a metal, a side quest, a dusty relic. And then, on January 7th, 2026, silver did something Wall Street never wanted to see in public. It briefly valued itself bigger than the AI king everyone worships, bigger than Nvidia, about $4, 65 trillion. While most people were asleep, the scoreboard flipped. And that flip matters for one brutal reason. It wasn't silver going up, it was trust going down. When a periodic table element starts outranking the poster child of the digital future, the market isn't celebrating technology, it's escaping fragility. Quick intro, you're here with us, and we're going to cut through the polite lies and look at what the numbers are actually doing. Before we go further, hit subscribe. Not because we need support, but because the next 60 days could redraw what wealth even means. And I want two things from you in the comments. First, where are you watching from? Second, do you think this is a real rotation or a temporary glitch? I'm reading. Now let's lock in the event, clean and simple. January 7th, silver's total market value pushed into the $4.65 trillion range, and in the process, overtook Nvidia's market cap. The pet rock beat the AI god, even if only for a window. And that window is a warning flare. Because Nvidia represents a story where the future is code, chips, cloud, and convenience. A story where assets live as numbers on a screen and risk is something you can hedge away with more numbers on a screen. Silver represents the opposite. Silver is weight. Silver is chemistry. Silver doesn't need a password. It doesn't need a functioning clearinghouse. It doesn't need a friendly regulator. It just sits there, silently calling everyone's bluff. So why would capital even allow this crossover to happen? Because capital's terrified of one thing: counterparty chains. When you own a tech stock, you don't own a thing you can hold. You own a claim. Your broker is a claim on a custodian. The custodian is a claim on a clearing system. The clearing system is a claim on the stability of the banking system. The banking system is a claim on the competence of central banks. And central banks are a claim on politics staying calm. That's a long chain for a world that's getting shakier by the week. Silver cuts the chain. It's a zero counterparty asset. It's not someone else's promise. It's Adam's. And in 2026, institutions are relearning the old rule. Promises fail. Atoms don't. Here's the mistake most people make right here. They see $80 silver and their brain screams, expensive. Because 5 years ago it was under $25. Because it looks like a rocket. Because your chart app is trained to trigger emotional reflexes. But $80 isn't expensive. $80 is a distorted measurement because the measuring stick currency has been stretched, warped, and quietly replaced. Imagine measuring a room with a tape measure that's been stretched longer every year. The room didn't grow, the tape lied. That's what fiat does. The dollar is the tape. So let's do the uncomfortable math. In 1980, silver hit about $50. People still treat that like a mythical ceiling, like nature itself declared, "Thou shalt not pass." No, that was $1980. Different tape, different world. If you simply adjust $50 from 1980 to 2026 purchasing power using official inflation math, you land roughly in the neighborhood of $170. Even that is conservative, because official inflation isn't a neutral scoreboard. It's a political instrument. They change the rules. They soften the numbers. They shave the edges so the public wouldn't riot. So if $50 in 1980 maps to around $170 today, what is $80? It's not an all-time high. It's not even close. It's a discount. A loud one. And here's the part. Nobody wants to say out loud, silver is one of the only major asset classes that never fully repriced for decades of currency debasement. Real estate repriced, stocks repriced, tech repriced to the sky, even gold repriced. Silver stayed chained. That's not because silver is boring. That's because silver is small enough to control until it isn't. This is the beach ball problem. You can hold a beach ball underwater for a long time. It looks stable. It looks like you solved gravity. Then your arms get tired. Or the water shifts. Or someone bumps you. And the beach ball doesn't rise gently. It explodes. That's what $80 silver is. It's the surface tension. It's the moment the ball is starting to fight back. Now watch this, because it's where the story turns from price into structure. There's a silent battlefield under New York. Not the headlines, not the talking heads, the vaults. Silver doesn't trade like a normal product. It trades like a two-layer system. Paper promises on top, physical metal underneath. The paper layer is huge. It's a casino. It's the place where price is discovered by leverage, algorithms, and positioning. The physical layer is small. It's the place where reality lives. When paper and physical agree, nobody notices. When they diverge, that's when markets break. And right now, they're diverging. January is supposed to be quiet in the futures world. Not a big delivery month. Historically, the delivery action is lower because major delivery cycles cluster in specific months. But January 2026 didn't behave like January. It behaved like a fire drill. Within the first days of the month, thousands of contracts stood for delivery, around 4,797 contracts. Each contract is 5,000 ounces. Do the multiplication, and you're staring at roughly 23. 5 million ounces demanded fast in a month that's supposed to be sleepy. This is not normal participation. This is institutions saying, no, we don't want your cash settlement, we don't want your roll, we want the metal. And that single shift is how you stress test the entire system. Because the modern commodity exchange model is built on a fragile assumption. Most people don't take delivery. Most people settle, roll, or cash out. The paper claims are far bigger than the physical base because the system expects the base won't be asked to support the whole building at once. That's fractional reserve logic. It works until it doesn't. Now, why is the January drain so important? Because March is coming. March is one of the major delivery months. That's when industrial users and large players traditionally line up. That's when the system expects pressure. That's when the exchange needs its buffer. And January just stole the buffer. If you're a manufacturer who needs silver for production, electronics, medical, solar, defense, what are you thinking as you watch January delivery numbers explode? You're thinking one sentence: if I wait, I might not get it. That's the ignition spark for a delivery cascade, a chain reaction, a bank run, but with metal. And when people start treating futures contracts like claims they must convert into physical, the exchange faces a problem that can't be solved with speeches. Because you can't print silver, you can't QE your way into atoms, you can cash settle, you can change rules, you can raise margins, you can suspend trading, you can offer alternative delivery. You can do the whole theater, but you can't invent metal. So the question we need to ask right now is simple and sharp. If January pulled 23, it's 5 million ounces early, what happens when March demand shows up on schedule? That's the 60-day fuse. That's why the calendar matters. That's why the next 2 months are not just another quarter. They are a pressure cooker. And I want you to feel the psychology here, because psychology moves faster than supply chains. When the crowd believes delivery is guaranteed, they accept paper. When the crowd suspects delivery is questionable, paper becomes a hot potato. Nobody wants to be the last person holding a promise when the physical shelf is empty. Now, there's another layer that makes this even more explosive: the narrative war. Mainstream finance loves to frame silver as an industrial metal or a speculative trade. They treat it like a mood ring, up when growth is up, down when risk is off. But silver is not just industrial, and it's not just monetary. It's a hybrid. It's money with a job. That matters because it means silver gets demand from two directions at once: people who want protection and industries that need function. In a clean, stable world, that's fine. In a stressed world, that becomes a collision. Think about what happens when a recession hits and central banks respond the way they always respond. They cut, they print, they stimulate, they inflate. Industrial demand can dip, sure, but monetary demand surges. And because silver is smaller than gold, the surge hits harder, faster. This is why silver acts like a spring. You compress it for years, and when it releases, it snaps. Now, let's talk about the tariff fear story, because it's one of the favorite tools used to scare people out of metals. You'll hear, trade restrictions will hurt growth, hurt demand, and therefore hurt silver. That's the clean story. It sounds logical. It's also incomplete. Tariffs don't make things cheaper. They make them more expensive. They break supply chains. They force reshoring at higher cost. They push prices up even as growth slows. That's not deflation. That's stagflation. And stagflation is the environment where people stop trusting paper narratives and start trusting hard assets. In the 1970s, the economy didn't need to be strong for metals to surge. The currency needed to be weak. So if trade wars accelerate, the silver bearish thesis becomes a self-own. Because political stress tends to trigger monetary response. More spending, more subsidies, more deficits, more printing. And silver doesn't care about political speeches. Silver responds to dilution. Now let's slow down for 1 second and separate fact from interpretation, because we're not gambling, we're measuring. Fact: silver's market value briefly pushed above Nvidia's market cap around January 7th, 2026, near $4. 65 trillion fact. Silver was trading near $80 per ounce in the script's framing. Fact: unusual early month futures delivery demand hit the system with thousands of contracts standing for physical delivery. Interpretation: institutions are rotating into physical assets because they distrust the stability of paper chains. Interpretation: March could stress the exchange if physical inventory is insufficient to meet delivery demand. Possible risk: exchanges can change rules, settle in cash, and delay or disrupt physical delivery, which can distort price while shortages intensify. This is educational. We manage risk. Now, here's where this gets personal for you, because there are two silvers you can own: paper silver, futures contracts, some ETFs, and derivatives that live inside the system. Physical silver, the metal, the bars, the coins, something that can't default. Paper silver behaves like a trade. Physical silver behaves like an escape hatch. If a delivery failure happens, paper silver can be forced into cash settlement at the exact moment you wanted metal. That's the nightmare. Getting paid in the currency that's failing, right when the hard asset is screaming higher. So when we talk about $200 targets and rotation of the century, the real question isn't, what's the chart do? The real question is, what happens when the paper layer can't match the physical layer? Because when that gap opens, prices don't move linearly. They gap, they jump, they whip, they break people's nerves. That's how squeezes work. And that's why we have to be honest about timeline. This isn't a sometime in the next decade story. The delivery clock is ticking in weeks. Now let me give you the cleanest mental model for what might happen. Imagine a theater that sold 1,000 tickets for 200 seats because most people don't show up. That works until one night everybody shows up. The staff doesn't argue about efficient market theory. They panic, they lock doors, they offer refunds, they call security, they change rules. But the people who needed those seats because they traveled, because they planned, because it matters, those people don't want refunds. They want access. That's silver delivery in a nutshell. And the exchange sold far more claims than it has physical seats. It assumes not everyone will demand the seat. January just suggested that more people are demanding seats early. So March becomes the night the lobby fills. Now ask yourself, if you're an institution and you see this building pressure, what do? You don't wait for the headline, you move before the crowd. That's why the Nvidia flip is so important. It's not silver won a beauty contest. It's a signal that big money is starting to treat metal as a core asset, not a curiosity. And once institutions reclassify an asset in their models, from alternative to strategic, allocation changes are not small. They're not emotional, they're mechanical. A pension fund shifting 1% into silver is not a meme, it's billions. And silver is tiny, that's why the move can get violent. Now, let's talk about the $200 target, but we're going to do it in a way that doesn't sound like a hype poster. $200 is not a magical number. It's not because I feel it. It's an inflation-adjusted sanity check. If silver was $50 in 1980, then a world with massively larger money supply, higher nominal asset prices, and decades of currency erosion does not justify $80 as a ceiling. It justifies something much higher. Even conservative purchasing power math lands you well above $100. More aggressive methods land higher still. So $200 becomes a midpoint between official reality and lived reality. This suggests upside case. If the market decides silver should simply match its historical purchasing power, $200 is not outrageous. It's normal. Possible downside case, if markets deflate and monetary demand weakens temporarily, silver can pull back with risk assets because it trades in a leveraged arena. But watch the tell. If spot drops and physical premiums stay high, the paper move is noise. Now, what about the largest asset language? The bigger than Nvidia moment creates a psychological shock, but the bigger story is that silver is climbing the global asset ladder and dragging attention with it. Attention is a lubricant. It brings liquidity. It brings new buyers. It brings FOMO. And FOMO, in a small market, is gasoline. So here's the question that matters more than any price target. When the crowd finally believes the story, will there be any physical left? Because that's the cruel pattern in every real squeeze. The chart goes up, and the product disappears. You don't want to learn that lesson at $120 when the dealer shelves are empty and delivery times stretch into months. You want to be early enough that the system still pretends everything is fine. That's where we are right now. And that brings us back to the 60-day window. We have a countdown to March. We have early month delivery pressure already firing. We have a narrative shift where silver starts outranking tech icons. We have a macro backdrop where debt, deficits, and policy stress keep feeding currency dilution. So the next move isn't about will silver go up? It's about will silver break the paper structure? And when structures break, they break suddenly. They don't send you a polite email. They don't give you time to rebalance. They snap. Now, a quick warning. Volatility is a weapon. If you decide to pay attention to this market, you're going to see days where silver is up hard, then slammed down, then up again. That's not proof the thesis is wrong. That's proof the arena is contested. The goal of volatility is psychological, to make you nauseous, to make you quit, to make you hand over metal exposure to someone with stronger stomach. If you're watching the price every 5 minutes, you're playing their game. We need to watch the signals, not the noise, delivery stress, physical premiums, inventory changes, and the willingness of large players to take metal instead of cash. Now, I'm going to leave you with one last open loop because this is the piece most people aren't even looking at. If March pushes the exchange toward cash settlement pressure, there's a secondary consequence: credibility. A delivery system that fails once doesn't just lose metal, it loses belief. And belief is the foundation of paper pricing. And if you think this can't happen because they'd never allow it, remember, exchanges have changed rules before. They cancel trades, they hike margins, they pause markets, they protect the system, not you. If the choice is your delivery or their reputation, guess which one gets sacrificed in broad daylight. So here's the cliffhanger. If the exchange is forced to solve a physical problem with a paper solution, what happens to the public price discovery mechanism afterward? Do we get a two-tier market, paper silver at one price, physical at another? Do we see premiums detach completely, turning spot into a useless number? Or do we see the entire structure reprice upward to prevent the next run? That answer decides whether $200 is a target or a waypoint. So tell me in the comments, if you had to watch one signal over the next 60 days, inventory, premiums, delivery notices, or price, what would you choose and why? And again, subscribe. Because if March turns into a delivery stress event, you're going to want the next update before the crowd understands what just happened.